Did you know there's an AI stock trading right now near its 52-week low, while some Wall Street projections are pointing to more than 300% of potential upside? That's the kind of gap that makes people stop scrolling. And today, we're pulling apart exactly what's happening with this company, why the chart looks so ugly, and the handful of things that almost nobody in the comments section seems to be talking about. Welcome back to the channel. Today, we're taking a deep, honest look at Rezolve AI, ticker symbol RZLV. We're going to walk through the bull case, the bear case, and everything in between so that by the end of this video, you can make up your own mind. If you find breakdowns like this useful, do me a quick favor and tap that like button and consider subscribing because it genuinely helps the channel keep making these deep dives. All right, let's get into it. So before anyone gets carried away, let's just look at the numbers sitting right in front of us. Currently, RZLV is trading right around $2.31, which is practically scraping the bottom of its 52-week range. But here's the part that raises eyebrows. Roughly 36% of the public float is currently sold short. That is a huge amount of bearish positioning. And at the same time, some fair value estimates are pointing to well over 300% of theoretical upside. So you've got this strange divergence. On one side, a beaten down price and a mountain of short interest. On the other side, analysts and models suggesting the company could be worth far more. That contradiction is exactly what we're here to understand. But wait, if the projected upside is supposedly so large, why on earth is the chart bleeding out like this? Well, let's actually look at the chart because it's not pretty. The stock is down over 16% year to date. It's trading well below its 50-day moving average of around $2.62 and below its 200-day moving average of roughly $2.73. When a stock is under both of those lines, it tells you the trend has been firmly against the bulls. On the balance sheet, the current ratio sits at about 0.67, which hints at some short-term cash tightness. That's worth keeping in mind. On the other hand, they're not drowning in debt, with a debt-to-equity ratio of just 0.21, which is actually pretty manageable. And there was one interesting footprint on the tape, a massive 52 million share volume spike on June 30th. When you see volume like that at these depressed levels, it at least suggests somebody is paying attention down here. But that's only half the story. To understand what might really be going on, we have to look past the rearview mirror and into what the company is actually building. Right now, the market seems laser-focused on backward-looking liquidity concerns and heavy short pressure. But the corporate side of the story looks very different. They recently launched a new AI product, they've proposed a merger, and insiders have been buying shares. The question worth asking is whether the market is underappreciating what's coming next, or whether it's pricing in these risks for good reason. Let me show you the pieces and you can decide for yourself. Let's start with a partnership that could matter quite a bit. Here's a real problem in the enterprise world. Big companies are genuinely nervous about so-called black box AI. They need to understand why an AI system makes a given recommendation, especially in regulated industries. This is where Rezolve's Auditable AI comes in. The pitch is that it provides human-readable, verifiable explanations, with the company claiming a 3.7 times improvement in transparency compared to standard large language models. But the more interesting part is distribution. They aren't trying to sell this entirely on their own. They've partnered with Tata Consultancy Services, better known as TCS, one of the largest IT services firms in the world, to help push this into large enterprise accounts globally. If that partnership delivers, it could be a meaningful channel. If it stalls, it's just a press release. That's the honest framing. And they aren't relying purely on organic growth either. Rezolve recently proposed an all-stock merger to acquire a company called Commerce.com. The proposed mechanism is a swap of 2 Commerce.com Series 1 shares for every 1 Rezolve ordinary share. The idea is to embed Rezolve's AI directly into Commerce.com's existing ecosystem of around 60,000 online stores. And notably for existing shareholders, they've said they're aiming to cap dilution at below 10%, which is something bulls point to as shareholder-friendly. Of course, a proposed merger is not a completed merger, and deals can and do fall through. So if the fundamental picture is genuinely improving, what are the larger players actually doing with the stock? In the first quarter of 2026, there was a notable institutional shakeup. Alyeska Investment Group completely exited a large position of nearly 15 million shares. Normally, a seller of that size can put real downward pressure on a stock. But interestingly, other institutions stepped in around these levels, including names like BlackRock, Weiss Asset Management, DeSalo Capital, and UBS Group, reportedly picking up millions of shares. Now, institutions rotate in and out of small cap names all the time, so this isn't a guarantee guarantee of anything, but it does show there are sophisticated buyers on the other side of that exit. Institutional flows are one signal, but arguably, there's an even more closely watched signal here. The CEO, Daniel Wagner, appears to be showing significant conviction. Since early 2026, through his entity DBLP CCAL, he's reportedly accumulated close to 9 million shares. Open market records also show him directly buying an additional 812,000 shares for roughly $3.25 million of his own money. Insider buying isn't a magic guarantee, and executives can be wrong about their own companies, but it does tend to catch the attention of the market. Management has laid out an ambitious target of around $360 million in revenue for 2026, which would represent something like a 7-fold increase from the prior year. That is a very aggressive goal, and it's fair to be skeptical about whether they can hit it. Now, none of this matters if we ignore the risks, and there was one significant cloud hanging over this name. There had been a meaningful legal overhang involving a defendant who allegedly sold RZLV shares that were held in trust. According to reports, that situation has now been largely resolved. DBLP CCAL secured a high court committal order. The defendant was sentenced to 2 years in prison, and DBLP obtained a summary judgment for $7 million. For shareholders, the takeaway is that a major distraction and a source of uncertainty appears to have been cleared. Removing an overhang like that can sometimes let a stock trade more on its fundamentals. So when you stack all of this together, what is the stock arguably worth? Here's where the disparity really stands out. The current price is around $2.31. One valuation model from Simply Wall Street pegs fair value at about $10.75. The Wall Street average price target sits near $11. On paper, that implies upside of well over 360%. But, and this is important, price targets are opinions, not promises. In fact, to keep things balanced, Weiss Ratings currently maintains a sell rating on the stock, citing execution risk. So this is very clearly not a consensus slam dunk. The gap between the current price and these targets is real, but so is the uncertainty about whether that gap ever closes. And that gap is exactly what makes the next factor so interesting. Remember that short interest we talked about? We're looking at roughly 38 million shares sold short, with a days to cover ratio of about 2.2 days. In theory, that's a lot of positioning that would eventually need to be unwound. Bulls argue this could act as fuel if positive news forces short sellers to buy back shares. But it's worth being clear-eyed here. Shorts are often short for a reason, and a heavily shorted stock can just as easily keep grinding lower. A squeeze is a possibility, not a plan. If we peek at the options market, we can see roughly where traders are drawing their lines. Looking at the July 24th options expiry, there's a notable concentration of put contracts around the $2.50 strike, with over 3,600 contracts. That can act as near-term resistance. On the upside, there's a cluster of call contracts around the $3 strike, with over 3,100 contracts. On top of that, implied volatility is extremely elevated, ranging anywhere from over 100% to, in some cases, over 700%. In plain English, the options market is pricing in the expectation of big moves in either direction. So how might someone even think about a name like this? I'm not going to tell you what to buy or sell because I'm not your financial advisor, and that wouldn't be responsible. But I can point out the levels traders are watching. The current lows near $2.31 are being treated as a reference zone. The 52-week low around $2.05 is the line many technical traders view as thesis breaking, meaning a sustained close below it would suggest the bull case is broken. On the upside, the friction zone between $2.50 and $2.62 lines up with both that put concentration and the 50-day moving average. And above that, the $3 level is where the call activity clusters. How anyone weighs those levels and how much risk they're willing to take is entirely a personal decision that should involve your own research. If you were tracking this story, there are 3 things worth watching closely. First, volume. For any real move to be sustained, daily volume would likely need to decisively beat the roughly 14.5 million share average. Thin volume moves tend to fade. Second, watch for any formal progress on the Commerce.com merger. A proposed deal becoming a formalized one would be a genuine fundamental development, whereas silence would tell its own story. And third, keep an eye on the $2.50 options level, since that's where a lot of the near-term tug of war is concentrated. These are the kinds of signposts that that separate a real story from a hopeful one. Now, before we wrap up, I need to say this clearly and directly. This video is for educational and entertainment purposes only. It is not financial advice, and I am not a licensed financial advisor. Everything discussed here, the price targets, the short interest, the merger, all of it, is information you should verify and research independently. Small cap AI stocks like this one can be extremely volatile, and it's entirely possible to lose a significant portion or even all of your investment. Never invest money you can't afford to lose, and please consider speaking with a qualified professional before making any decisions. So pulling it all together, Rezolve AI is a genuinely fascinating and divisive story. On one side, you have a beaten down chart, real liquidity concerns, and a sell rating from at least one ratings firm. On the other, you have a TCS distribution partnership, heavy insider buying, a proposed merger, a recently resolved legal overhang, and an enormous amount of short interest that some believe could ignite. It is without question a high-risk, high uncertainty situation, and both the bulls and the bears have real arguments. That brings me to my question for you. Looking at everything we covered, which factor matters most to you? The insider buying, the short squeeze potential, or the sell rating and execution risk? Drop your honest take in the comments because I read them, and I genuinely love to hear how you're weighing this one. If you got value from this breakdown, please smash that like button, hit subscribe, and turn on notifications so you don't miss the next deep dive. Thanks so much for watching, take care of yourselves, and I'll see you in the next one.